Welcome back to Technical Analysis Simplified. My name is Michael. I'm going to talk about making ridiculous gains from the market. Now, I've been at this game for about 12 years now, and in that time, I've made just about every mistake in the book. Using leverage, using it too aggressively, and also being too conservative. But obviously to make ridiculous gains, there's usually a serious amount of leverage involved. So we're going to be going through a few examples of how people get themselves wrecked and also ways we can use it to our advantage. Having been at this game for over a decade, there's probably quite a lot I take for granted that just becomes second nature to me, having done it for so long. But obviously anybody new coming into this space, there's a lot that they don't know, and it's just a matter of being in that unconscious unawareness. So you just don't know what you don't know until somebody, brings some light to you that you can go away and study it further. So that's what I'm trying to do with this video, just kind of highlight the differences between trading spot and also been trading with leverage as well. And, really the pitfalls and, benefits as well. They've all got their benefits and drawbacks. Neither is good nor bad. It's just how people use these tools. So this is a hypothetical trade. I'm using a dummy account. I'm not taking these trades. And obviously I don't recommend anyone going as extreme as what we're going to be going through. It is purely just to highlight the examples of what the differences are using stop losses and how ridiculous gains can get when used with, that precision. At the end of the day, traders and investors, the ones who are professional, are essentially just risk managers. They just know how to manage risk really, really well. When there's obviously opportunity on board, they know how to kind of pile in and take advantage of it. And also when it's a risk off environment, they can pull themselves in. Whereas amateurs in this game just really don't know how to manage risk properly. Sometimes they can be right on the market, but they don't, they're not really positioned properly to take advantage of it. And when they're wrong, they're probably overexposed as well. So it really is the question of how much, that position sizing question. That's what we really learn in this game after having been at it for quite a long time. So if anything, I hope this video just opens your eyes to position sizing, some of the pitfalls, downfalls, how it can be used to our advantage, and also what to look out for. I'm not a financial advisor, so everything I say is general information and for education and entertainment purposes only. Trading and investing is incredibly risky, so you must always do your own due diligence, seek your own professional help and guidance before making any decision in the market. And past results are not indicative of future performance. Now, as you can see on the right, I have a dummy account of $10,000. I'm just looking at risking $5,000. So in the event, everything I'm looking at here, if I'm wrong in these examples, $5,000 is going to be eliminated, risking half the account. So obviously not advisable, pretty ridiculous to risk 50% of any account. But for the purpose of this exercise, that's what we're going to be looking at. I'm going to be using that $5,000 to figure out the how much question, how much to be buying and how much to be selling. So you can see the hypothetical trade here that I'm going to be entering with momentum if the price breaks $31,000 in this case, or going short if the price dips and hits $28,000. So there's kind of a bet each way here, trying to make money if it goes up or also if it falls, going long and short. And you can also see that window in the middle where it just says do nothing. So in that case, maybe the market grinds around and there's no particular trade, but it will have to break out eventually. So we'll look at the long example first. Remember, $5,000 risk. First instance, we're not using any leverage at all. So to figure out the how much question, how much can be bought, if we're entering at $31,000, once again, with our $5,000 risk, we have to figure that out by dividing our $5,000 by $31,000. And that's going to tell us how much Bitcoin we can buy. So the position size in this case is 0.1613 for round numbers. So in this case, let's say Bitcoin goes to zero. That's what needs to happen for the whole $5,000 to be completely wiped out. After all, there's no leverage, so we can't get liquidated sooner. So that $5,000 down to zero means Bitcoin is wiped out. The other side of that is, let's say the target's reached. So $31,000 to $37,000 is obviously $6,000. But since I couldn't afford a whole Bitcoin, there's only that 0.1613, I'm not going to profit that $6,000. I'm going to be profiting a fraction of that. So to figure out how much profit I've made on that $5,000 purchase at $31,000, we have to do our $37,000 multiplied by how big our position was at 0.1613. We can see that we end up with $5,968, obviously minus our initial investment. So the profit on that trade was $968 or just under 20%. So I hope by now everything's still pretty straightforward. But now if we're going to be looking at the short example, it's just the same thing, but obviously we're selling first and buying cheaper to hopefully make that difference in profit. But the difference here is a liquidation. The way that it would get automatically liquidated is if the price doubles from our entry price, because there's no leverage at all. It has to essentially do, double where it's at, and that's going to liquidate the market or liquidate this particular position. But in terms of a position size, we have our $28,000. We're still risking our entire $5,000. So we're going to do 5,000 divided by 28,000. That's going to give us our position size. So we can afford to sell. We sell first when we go short, 0.1785 Bitcoin. And let's say our short target is reached. Bitcoin does fall to that $22,000. We have to figure out how much profit we've made on that $5,000 short sale. So in this case, we're doing 0.1785 multiplied by our target was reached of $22,000. And you can see the position is going to be worth $3,927. But remember, we're going short, so we actually still make the difference in reverse. So the profit is in fact $1,073 or just over 20%. So you might be wondering, how can the short profit be greater than the long profit if they're both $6,000 per Bitcoin? Well, you have to remember, we weren't purchasing one Bitcoin. We had different position sizes. And you also have to remember that the percentage drop from 28 grand down to 22 grand, it's a greater percentage drop than it would be a percentage rally from 31 to 37,000 bucks. That's how the profit ended up being more on this particular short trade. So as you can see, using no leverage at all, there's still a reasonable gain to be made in a $6,000 move. But you have to keep in mind that there wasn't a whole Bitcoin being purchased, just a fraction of a Bitcoin, because that's all we could afford with the $5,000 risk. Now, to spruce things up, we're going to be looking at purchasing one whole Bitcoin. We don't have enough money in the account. We're risking $5,000. We have a $10,000 account. We don't have enough to purchase a whole Bitcoin in the spot market, so this is where leverage comes into it. The numbers here are far more simple because we're purchasing one Bitcoin. We're using some leverage. We know that 37,000 or 31 to 37 grand is a $6,000 profit. So since we're buying one whole Bitcoin, the profit is clearly 6,000 bucks. Very easy to work out. But the profit on our $5,000 ends up being 120%. Because obviously 5 grand to 6 grand, we're making 120% of our money. So it's pretty damn good, but obviously the risks are involved of getting liquidated sooner. Because we are purchasing one whole Bitcoin, the price would have to drop from 31 grand down to $26,000, being a $5,000 move, and then this leverage position would automatically be liquidated. Now the numbers on the short side are just as easy. We're selling one Bitcoin, we're going short, and then we want to see the price fall to 22,000 bucks. 28 grand to 22 grand is still $6,000. It still ends up being 120% profit. And you might be wondering, how can that be? Previous trade, we made more when we went short. Well, keep in mind, last time there was a bigger position going short than going long. This time the position size remains constant. So the profit also remains constant, being a $6,000 move from 37 to 31 and also 28 to 22. What I'm going to do now is introduce the concept of a stop loss. So let's say I was really, really confident in this particular setup I'm looking at, buying at 31 with a target of 37,000 bucks. But what you can also see is another line on the chart. So let's say I was super confident and I wanted to only have a $250 risk per Bitcoin. So what that means is if the price of Bitcoin was to rally, it hits my entry stop at 31,000 bucks. I don't anticipate it coming back to $250 beyond the entry price. So that being the case, I'm only risking 250 bucks. What that would look like in terms of position sizing is I would have to divide my $5,000 risk by $250. By doing that calculation there, I'm risking 250 bucks per Bitcoin. It tells me what my position size can be. So I've got a $5,000 risk. I'm risking $250 per Bitcoin. It means I can buy 20 Bitcoin. Now, at a price of $31,000 each, that means my position size is actually going to be 620 grand, which is insane in terms of, this particular account size and managing risk. But even so, hypothetically speaking, it would be possible with a $10,000 account using something like 100x leverage, because obviously that would give exposure or buying power to $1 million bucks. Now, of course, I'm certainly not recommending anybody go out and 100x leverage their account. I'm just showing you the differences between, managing risk and how some pros do it, depending on how tight their levels are and using stop losses. So the main difference in these examples is obviously one is the leverage and two is the implementation of a stop loss that ends up being pretty close to the market. That's what allows traders to really increase their position size by, if they've got that high conviction, they can have tight stops and just multiply their returns based on how big their position is. But in terms of how much money would be made for this same trade, using a $250 stop loss in this case, we have our 20 Bitcoin position size. That's what we've got here. And we're making $6,000 per Bitcoin. Remember, there's 20 Bitcoin. It ends up being $120,000 worth, or 2,400%. But you just have to think about the probability. Position size is one thing, but the probability is obviously another thing as well. So if we're getting that entry at 31 grand, there's a high probability it's going to come back and stop the market out, stop the position out, and lose that entire 5,000 bucks. Whereas using something like that one Bitcoin example, the price actually has to come back to $26,000 to be liquidated. That's the biggest difference here. So of course, one thing is position sizing, the other thing is probability. There's a high probability with a stop further away that the target's going to get reached. And obviously if the target or the stop loss is closer, there's a much lower probability of reaching that target. As for the short side of the market, the numbers work out exactly the same. We can sell 20 Bitcoin short, and the profit in this case would also be 120,000 bucks or 2,400% return. So once again, the sword does cut both ways. It is just a matter of managing risk and having expectations in line, because I want to repeat it again, the probability of entering and getting stopped out is much greater than if the stop was further away, for this long trade example. So it's just all a balancing act in terms of managing risk. So while we didn't get to that 100x on the account, I'm sure you can start to see how position sizing makes all of the difference. With using no leverage, only 0.16 could be purchased. We can use some leverage and comfortably buy one Bitcoin with a $5,000 risk. Obviously with a $10,000 account, it's certainly not advisable because you're risking half your account would only take 2 losses to be wiped out. But nevertheless, then implementing something like a stop loss is what really supercharges the position sizing and can leverage up the account pretty big, still fitting in with obviously whatever this particular trader or hypothetical example was looking at. So overall, it was a pretty dry episode where we just did look at some numbers and obviously a hypothetical example, but I hope it was enlightening to at least some of you, thinking about the differences between spot and also leverage, the dangers and obviously the advantages as well. It's all a two-edged sword. There's always benefits and drawbacks and things to keep in mind. Just a reminder about our 2 Ethereum giveaway for viewers of this channel and also Jason's channel. There's a Bybit link in the description where you open your account, deposit at least $10, and there's 4 winners of half an ETH each. If you enjoyed this drier style of video, we just punch some numbers, let me know in the comments section. Otherwise, I'll happily do some more clickbait titles and thumbnails for everyone. As always, thanks for tuning in, and until next time, I'll catch you then.